Credit cards. Ramit Sethi begins his philosophy not with complicated budgets or spreadsheets, but with a simple plastic card. He starts with credit cards because they quietly shape a person's financial reputation long before wealth ever appears. In modern financial systems, a credit history acts like a hidden scorecard that banks, landlords, and lenders rely on when deciding whether someone is trustworthy with money. Many people grow up hearing that credit cards are dangerous, and in many cases they can be. But Ramit explains that the danger does not come from the card itself. It comes from using borrowed money without a clear system. When used correctly, a credit card becomes a controlled tool. Paying the balance in full each month builds a strong credit history while avoiding interest charges. Over time, that simple habit unlocks better loan terms, lower interest rates, and more financial opportunities. The deeper lesson is about responsibility. Instead of fearing financial tools, people can learn to use them with precision and discipline. Credit score. Closely connected to credit cards is the credit score, a number that quietly influences major life decisions. This score is calculated from patterns of borrowing and repayment, including how consistently bills are paid and how much credit is used. Many people never learn how it works, yet it affects mortgages, car loans, and sometimes even job opportunities. Ramit emphasizes that improving a credit score is rarely about dramatic actions. It usually comes from a few steady habits practiced over time. Paying bills on schedule, keeping balances low relative to credit limits, and maintaining long-standing accounts all contribute to a stronger profile. A high credit score signals reliability, and reliability reduces financial friction. What might seem like a small number on a report can shape the cost of borrowing for decades. Bank accounts. After addressing credit, Ramit turns to the structure of everyday banking. Most people place all their money in a single account and try to mentally track what each dollar is meant for. This approach often leads to confusion and accidental overspending. Instead, Ramit recommends separating money into clearly defined accounts so that every part of income has a purpose. A checking account handles daily spending and bill payments, while a savings account protects money meant for emergencies or future plans. Some people also maintain additional accounts for specific goals. The goal is not complexity, but clarity. When money is physically separated, the brain no longer has to constantly calculate whether a purchase is safe. The system itself provides that answer. High-interest savings. Savings accounts become more powerful when they are placed in institutions that offer higher interest rates. Traditional banks often provide very small returns on deposited money, sometimes barely noticeable over a year. Online banks and specialized savings platforms, however, often offer significantly better rates because they operate with fewer physical branches and lower overhead costs. Ramit highlights these accounts as a place where emergency funds and short-term savings can quietly grow. While the interest may not create dramatic wealth, it reinforces a useful principle. Money that sits still should still be working in some small way. Over time, even modest growth strengthens the habit of protecting financial stability. The conscious spending plan. Instead of promoting strict budgeting, Ramit introduces the idea of a conscious spending plan. Traditional budgets attempt to track every dollar with strict limits, which often makes people feel restricted and eventually leads them to abandon the system entirely. The conscious spending plan takes a different approach. It encourages people to decide in advance which categories of life deserve the most financial attention. Essential expenses naturally come first, followed by savings and investments. The remaining portion becomes guilt-free spending for things that genuinely bring value to life. This structure creates a healthier relationship with money. Rather than feeling punished for spending, people feel confident because the important financial responsibilities have already been handled. Fixed costs. Within the conscious spending plan, fixed costs represent the foundation of financial life. These are recurring expenses that remain relatively stable each month, such as housing, utilities, transportation, and insurance. Because these costs are difficult to adjust quickly, they deserve careful attention when making major life decisions. Choosing a slightly less expensive apartment or reducing unnecessary subscriptions can create long-term financial breathing room. Ramit encourages people to focus on these larger recurring expenses rather than obsessing over small daily purchases. Adjusting a major fixed cost, even slightly, can produce more financial impact than cutting dozens of minor spending habits. Guilt-free spending. One of the most unusual parts of Ramit's philosophy is the concept of guilt-free spending. Many financial systems emphasize sacrifice and constant restraint. While discipline is important, Ramit argues that life should still include enjoyment. Once essential expenses, savings, and investments are handled automatically, the remaining money can be spent without regret. This approach removes the emotional tension that often surrounds spending. Instead of feeling irresponsible for enjoying a dinner with friends or buying something meaningful, people know those choices are already accounted for in their financial structure. This shift transforms money from a constant source of stress into something more balanced. Automation. Automation is the mechanism that keeps the entire system running smoothly. Human motivation rises and falls over time, and relying on willpower alone often leads to inconsistency. Ramit proposes turning financial decisions into automatic processes. Income arrives in a checking account, bills are paid automatically, savings are transferred to the appropriate account, and investments are scheduled to occur regularly. Once these systems are in place, financial progress continues even when life becomes busy or unpredictable. Automation handles the present, ensuring bills are paid and savings grow without constant attention. With that foundation in place, attention can shift toward the longer journey of building wealth. Investing. When the basic financial structure is stable, investing becomes the next stage. Many people assume investing requires expert knowledge or constant attention to market movements. Ramit challenges this belief by promoting simple long-term investment strategies. Instead of trying to predict which individual companies will succeed, he encourages investing in broad funds that represent entire markets. These funds hold shares in hundreds or thousands of companies at once, spreading risk and capturing overall economic growth. Historically, markets have experienced ups and downs, yet long-term investors who remain consistent often benefit from the steady expansion of global businesses. Compound growth. Behind the power of investing lies the principle of compound growth. When investments earn returns, those returns begin generating their own returns over time. The process is slow at first and often invisible in the early years. However, as the investment base grows, each percentage of return represents a larger amount of money. This gradual acceleration explains why long-term investors often see dramatic growth later in life. The concept is simple but powerful. Time becomes the most valuable partner in building wealth, and starting earlier provides a significant advantage. Negotiation. Ramit also places strong emphasis on negotiation, particularly when it comes to income. Many people focus heavily on reducing small expenses while ignoring opportunities to increase their earnings. Negotiating a higher salary, better freelance rates, or improved contract terms can create lasting financial impact. A single successful negotiation might increase income for years, making it far more powerful than many small cost-cutting efforts combined. But the principle does not stop there. The same confident, prepared approach can also be used to lower existing fixed costs, like a simple phone call to negotiate a better rate on internet or insurance bills. Ramit encourages preparation and confidence rather than confrontation. Negotiation, when done respectfully, becomes a conversation about value rather than a conflict. The rich life. The final concept that ties everything together is what Ramit calls a rich life. This idea moves beyond numbers and financial techniques. A rich life means designing a financial system that supports personal priorities and values. For one person, it may mean traveling frequently, while for another, it might mean supporting family members, pursuing creative work, or building a business. The purpose of budgeting, automation, saving, and investing is not simply to accumulate money. It is to create freedom and stability so that people can choose how they want to live. When the system works well, money gradually shifts from being a constant worry into a quiet foundation that supports a meaningful life. The goal is not simply to earn more, but to build a life where money quietly supports the things that matter most.